Buy the dip, of course. But do you have cash on hand to actually buy the dip? How much cash do you want in your reserves? And how much of your cash should be invested? It's a balancing act that every millennial investor goes through. I'm Skylar James, welcome back. How to decide the balance between cash and investments is a very personal question. My opinion, there are three things that need to be balanced: survival, the stock market, and real estate. This video is my strategy on balancing these three with insights from Wall Street bigwigs sprinkled throughout. There's also a secret sauce to this balancing act. See if you can figure it out before the end. We hear it all the time from pundits. They tell us to keep some powder dry for when there is a sale on stocks. But they also tell us that we should stay invested and not try to time the market. So let's look at these three factors and put each into perspective. Survival is first. Most financial advisors tell people to have 6 months of emergency money ready to go at all times. This could cushion the loss of a job or a sickness or an unexpected repair on your car or your house. The bottom line is you probably shouldn't be investing in the market if you don't have 6 months set aside for survival. Look, it's all about priorities and managing risk. Don't get yourself in a position where you have to sell off assets at a lower premium to cover emergency costs, or sell off assets that generate a taxable event because of an emergency cost. Have the cushion and be ready to pony up if a situation does come up. The second consideration is the stock market. If you are watching a finance channel on YouTube, you know that the market has not had a negative return over any 20-year period in the last 100 years. Downturns are blips on a macroeconomic timeline. You saw in March of 2020 that even during a major 35% sell-off, the market can surprise you with its resilience. I was lucky enough to push more money into my strongest conviction names during that time because I kept a rainy day fund. I was buying ETFs in sectors that I knew would rebound quickly. Frankly, hindsight's 2020 and I wish I'd put more in. But at the time, I didn't know if we were about to retest the low. Now, it's a chart phenomena that we often see during bear markets or corrections like 2008, 2009. This is an in-your-face example of market retesting the lows, and it happened again in 1987. Ultimately, there are two different situations in which you have cash on hand for the market. The first is because you are already in the habit of dollar cost averaging. Every month, you push in a set amount that fits your budget. Let's say the 15th of every month is the day that you purchase stocks or ETFs, but on the 13th, your favorite ETF drops 5%. Because you're smart and you have cash on hand ready to go, you buy that ETF on the 13th on sale instead of waiting until the 15th. That's one way of using the cash that you already have on hand. The other way, the more drastic way, goes back to that COVID crash. During a dramatic downturn, the smartest people, the big wigs on Wall Street, they have cash ready to go on those super once-in-a-generation buying events. Not a little cash, millions. In hindsight, wasn't the COVID crash maybe a once-in-a-generation buying event? I mean, the S&P has doubled off of those COVID lows, the fastest doubling in history. So what are some changes going forward that we can do to be ready for the next one? Well, in addition to having my 6-month emergency supply, in addition to setting aside a certain amount each month to dollar cost average into my holdings, I'm now keeping a rainy day fund equal to 10% of my market investments. So if you were to do this, and let's say you had 50,000 in stocks and ETFs, you would set aside $5,000 and only deploy it during, say, a 15% or more pullback. When you see the market fall 15%, you push that $5,000 in from your rainy day fund. If you have, say, $500,000 in stocks, you push in $50,000 during that big correction. But be disciplined. In the interim, that money sits in a money market paying 1 to 2%, and the funds are accessible with 24 hours notice. Now, there's an argument to be made where this cash could be allocated to a bond portfolio instead. That's a deeper analysis, but my short take on that is since we are at historically low interest rates, bond portfolio allocations will struggle as interest rates rise. So parking the 10% there doesn't give me the capital protection that I want. The hardest part of this strategy is convincing yourself that you don't have FOMO. It is tough watching stocks go up day after day, and instead of investing, you hold cash that depreciates day after day. But that's what the bigwigs do. Remember, back in 2019, that Berkshire Hathaway had over $100 billion in cash. Buffett said, I don't see anything that I want to buy. He's not buying just to buy, he's waiting for the right moment. And that's what the pros do. That's what the bigwigs do. That's what the super successful people do. And it's hard. Think back to those headlines from March of 2020. Professionals telling us that it's a once-in-a-lifetime buying opportunity. If you don't have that money set aside though, it becomes a once-in-a-lifetime regret. In fact, a report on world wealth from pre-COVID found that 28% of millionaires' assets had shifted to cash. How much of your investments are in cash? Probably not that much. I like to think of this like fishing, using dollar cost averaging and staying invested constantly expanding your portfolio. That's like fishing every day and being well fed. You're never going to go hungry. But these bigwigs who can stay disciplined and hoard cash don't go fishing every day. They used to, but they're so well off now, they don't need to anymore. But these bigwigs, they're waiting for the big one. Not with a fishing rod, not with a bucket of worms, but with a giant commercial fishing vessel and giant nets, and they scoop that multi-bagger. They don't want a few grouper fish, they want that marlin. They're looking for that mega buying opportunity, and we should too. To do that, we need enough cash on hand. So reset for a second. We talked about cash on hand for emergencies. We talked about cash on hand for buying the stock market dip. The final leg is real estate. Leg 3 is that many successful people have bought real estate during dramatic downturns. I've done it myself. I know other people who have, whether they're buying a property as their primary home or a vacation home or buying income property. Maybe you're buying REITs instead of physical property. The key is having what other people don't during that real estate fire sale. And what other people don't have often is cash, liquidity, good credit for the situation at hand. And here's the secret sauce, the fortitude to push into a market when all the news surrounding the market is bad. Think back to 2008. Real estate was just like March of 2020 was for stocks. If you were able to tune out all that noise and push your chips into the center of the table, you ended up in a much better situation looking back than if you had sat on the sideline and waited. I personally purchased 4 houses for cash during that market crash. Are you catching the theme of this? Half of winning during a downturn is having cash on hand, doing the research and willing to take on the risk of moving against the broader sentiment. It's that contrarian investment attitude, that willingness to go against the grain because you trust your system, your analytics, and you know that over time, asset appreciation will happen. Waiting until there's blood in the streets, including your own, to buy, as Buffett tells us, it's being greedy when others are fearful. Another Buffetism. Savers are people who are just hoarding money. They're losing decade by decade. They're losing in bonds, they're losing in cash, they're losing in money market funds, and they're losing in gold and silver. Asset owners have been winning for 25 years in this country. Nothing about that is going to change. I'm Skylar James. Thank you for watching, and I'll see you on the next one.